Thank you very much for doing that, Mike. Thank you. It's a pleasure to be here today in London. My name is John Carnegie. I'm a partner at Baillie, Gifford & Co. We're a small investment operation based in Edinburgh, Scotland. So we're a little bit different. We're a little bit chippy because of that, because we come from up north. I'm going to tell you today about one of my favourite things, and that's the Monks Investment Trust. It's a trust that Baillie Gifford's been managing for nearly 90 years, and I'm going to tell you a little bit about why I think it should be a part of your investment portfolio for a retiree. And there's a couple of messages I'd like to talk about today. The first is that global growth equities, which is what we do at Baillie Gifford, it's what the Monks Investment Trust invests in, is a very good way of offsetting the ravages of inflation for the typical time horizon of a long-lived retiree, which I hope all of you will be. And the second thing is that Monks Investment Trust is a very good way to get exposure to global growth equities, which can help you with the effects of inflation. But first of all, let me just turn to a little bit of history. I did mention that Monks Investment Trust has been around for quite a few years. Here we have a picture of some very well-dressed gentlemen in 1921. It happens to have been taken in Washington. And on the left, you've got a man with an amazing name, Sir Auckland Campbell Geddes. He's the gentleman on the left. And he was the man who founded Monks Investment Trust in 1929. Sir Auckland was a polymath. Listen to this for a CV. He was a soldier who served in the Second Boer War. He was a politician. He was ambassador to the US. He was a businessman. And if that wasn't enough, he was also a professor of anatomy. Top that. So Sir Auckland founded Monks Investment Trust in 1929 along with two other trusts. One was called Abbott's, the other one was called Friars, hence why we've got a funny name for our Global Growth Investment Trust today. Baillie Gifford took up over the management of all three of these trusts in 1931, and in the 1970s they were merged into one trust, into the best one, Monks Investment Trust. So whilst fashion may not have changed in the last 87 years, a number of things haven't. And one of the things that hasn't is Baillie Gifford itself. We're a firm that's been established since 1908. And we've got a rather unique feature, which is we're an unlimited liability partnership. Most partnerships these days have got limited liability, so if things go wrong, the people who run them can walk away with no particular liability. That is not the case at Baillie Gifford. We're an unlimited liability partnership. We have one business. We're long-only investors. We've got no distractions, no conflicts. We're focused on your best interests. That's producing very strong returns and getting rich slowly, not quickly. Monks was established in a very different era, but we're now investing in some of the most exciting companies around the world. This is a global best ideas portfolio. We've had exposure to artificial intelligence. We own the world's smallest heart pump, a company that makes the world's smallest heart pumps. We're focused on growth, those companies that are going to be double the size in 5 years' time. And we're also diversified, and this is something I'm going to focus on a little bit later, by the type of company and the type of growth those companies are going to produce. Monks Investment Trust's remit is to invest globally. We're looking to achieve capital growth. I'm afraid we're not that interested in producing high levels of income. And our global focus means around 95% of the assets today are invested outside the UK. So it really is a very global outlook on the world. So let's leave Sir Auckland and his friends. And just look at the first key point that I want to make to you today. Why should a retiree who typically would be looking for income want to buy a trust of growth equities? Surely you're all looking for income. I'm about to persuade you that that's not the case. It's all about the ability of the stock market investments to crush the effects of inflation over the long term. Assuming a retiree retires at 65, the average retiree will live for another 20 years. That's a very long-term time horizon, and you should all be encouraged to think about it. I'm just going to show you some statistics here. These are 20-year charts. They show three things. The first thing is the Barclays Cost of Living Index. So since 1997, that's risen by about 70%. In other words, £1 in 1997 is now worth about 58p today. The price of a loaf of bread has doubled. The price of a pint of milk has doubled. The price of electricity has gone up by 150% over those time periods. So all of those everyday utilities that you need are going to become much more expensive in the future. The second line, which is the blue line, is the FTSE World Index, the broad equity index. Whilst the cost of living has gone up by 70%, that line has gone up 4.5 times. Had you put your money in Monks, you would have done even better. It's gone up by 7 times over the last 20 years. So a very strong track record. To put it another way, inflation has averaged about 3%. Monks' growth has averaged about 10% had you reinvested the income. In real terms, Monks is worth 4 times had you put it in the bank. So that's a very strong recognition, I think, of the opportunities of investing in a global growth portfolio. Not for your whole portfolio, we don't produce an income, but we think if you want to offset the ravages of inflation, this is a very good way to do it. Let me now turn to the second part of my presentation. Hopefully I've convinced you to remain awake for the rest of the 15 minutes that I've got left, 14 minutes that I've got left. And now I want to concentrate on the attractions of Monks Investment Trust itself. This is an investment trust where we spread the risks of investing in global growth equities across a number of different growth types. And we want to ensure diversification, and we do it in a number of ways. The first way we do it is we have 3 different personalities managing the investment trust. This is the only joke you get from me. We have a Scotsman, an Englishman, and an Irishman. That's the truth. We have a pragmatic Englishman, if there is such a thing. We have a optimistic Irishman, if there is such a thing. And there's a lot of these about. We've got a pessimistic Scotsman. And we blend those 3 personalities together so they look at investment perspectives from different angles. Those 3 individuals have worked together for 13 years. They took over the management of Monks Investment Trust 3 years ago from another team at Baillie Gifford. Second point is that they seek out colleagues who are going to help them and challenge them. We don't want them to think that they've got all the good ideas. We want people to challenge and debate and discuss with them the merits of individual stock discussions. They use a pragmatic and independent risk team. And the other point I want to say, and I'm going to go into this in more detail, we spread our risks across a lot of different opportunities. There's 100 companies in this portfolio. There's about 20 different countries represented. We invest in lots of different areas of the stock market, so we avoid concentration in any particular industry, geography, or pattern of growth. And the title of this presentation is Global Growth from Different Perspectives. And we think that companies grow in a number of different ways. Growth companies don't all grow in the same way. And we think the opportunities and the challenges for different growth companies can be similar. So by categorizing the companies in 4 different ways, and I'm going to go into this in some more detail, we think that we can recognize those features, but also we can toggle between some of these different areas. Just briefly, the best way to look at this slide here is to look at the arrows which show you the way that earnings should grow for these 4 different companies. So just briefly, from left to right, we've got what we call growth stalwarts. These are steady growth companies, so we think their earnings should grow quite steadily over time. We think we can sleep quite easily at night owning those companies. I'll give you an example of one in a moment. Rapid growth is what I would call classic high growth investing companies, technology, healthcare, things that are really exciting, but there's also a big threat to these high growth areas, which is that new capital is being attracted to them. Thirdly, cyclical growth companies. The important thing here is the peak of the next cycle we hope will be higher than the peak of the last cycle. And ideally, we want to buy them at the bottom and sell or trim them at the top. But we think there's a long-term growth opportunity for these companies. And then lastly, but not leastly, are latent growth companies. These are companies that have had a poor earnings track record recently, but we think there's some kind of catalyst to make them grow a little bit faster in the future. So that's an overview of what Monks Investment Trust is trying to do. Let me dig into some real-world examples of the kind of stocks that we're investing in. I'll take you through those 4 growth categories, which helps give us the balance to that portfolio. First of all, growth stalwarts. These are very durable franchises. They're often companies that are well known. They're big companies. They've been well established. There's a lot of business-to-business organisations in here, like Moody's, which is a ratings agency for banks and other people who are lending money. They should grow in a very steady, predictable manner. It doesn't matter whether the economy plus 5% or minus 3%, these things should continue to do relatively well. They have strong customer relationships, strong brands. We'd expect them to grow about 10% per annum. That's higher than the average stock market growth, but it's clearly not the most exciting area in the market. We used to have 40% in this area when we came out of the financial crisis. We now got about 20%. So that shows you that we're able to toggle between different areas when we think the attractions are more or less attractive. The example I wanted to give of a growth stalwart company is Pernod Ricard. If you've been to a bar in France, you will recognize the bottle of the aniseed drink so beloved of the French people. That may not be your tipple, but don't worry. Pernod Ricard does lots of other things. Mumm champagne, Absolute vodka, Beefeater gin, and many more. So they cater for a lot of different tastes. Pernod should grow gently and steadily as drinkers in mature markets turn to premium brands, and those in emerging markets turn to Western brands. One of the interesting things about Pernod is it's the market leader in both China and India. And in those markets, only 1% of the beverages market is exposed to Western brands. So they've got a huge runway for growth. They're going to do it slowly and steadily. And one of the key features of Pernod is it's got a world-class distribution capability. In this industry, you need to be able to get your product into the bars, into the restaurants, into the supermarkets, and Pernod has a world-class capability here. Family-controlled, family-run companies often put a lot of people off. They worry that the next generation won't be as good as the last generation, or the person just gets the job because they happen to have the right name. Pernod is run by a gentleman called Alexander Ricard. He's the grandson of the founder of the Ricard company. He served 12 years in the company and another dozen years outside the company before getting the top job. His family own a quarter of the shares, so our investment is very much aligned with his, and we think he's had an excellent training. We know him very well, and we respect his ability as a manager. So that's a good example of a steady growth company that we think we can own for many years, hopefully even decades. Turning to rapid growth, this is the most exciting area in the stock market at the moment. All of those FANGs and BATs and online platforms and healthcare company, we've got a lot of these stocks, and it's our biggest of the four growth categories at the moment with about 40%. These are early stage businesses with huge opportunities. These are run by founders, these are run by innovators, these are run by people that you might think were utterly mad if you met them in the street, like Elon Musk, who runs Tesla. But they offer explosive growth in high growth dynamic markets, be they in technology, be they in emerging markets. We want these companies to grow at twice the rate of stalwarts or faster, and they're currently doing that very well. A number of today's most exciting companies will be in this category. I don't want to focus too much on technology, but we do have a lot of exposure to technology. But I thought I would talk about a stock which on the face of it is rather dull, and this is AIA, which is an insurance company based in Hong Kong. We all own insurance products, no doubt. It's something that we all feel we need. AIA is exciting because it has the opportunity to grow rapidly in Asia, which is going to be the biggest market for insurance, as for many other things over the next 2 to 3 decades. Just consider this. In Asia, by 2030, there will be 3.3 billion middle-class consumers. That's 10 times the size of either the European or the American market. And in Asia, you don't have the welfare safety net that we have in the UK. You don't have a national health service. So you have to pay for those services yourself. So in steps AIA and a lot of other insurance companies and offers products which can help you in retirement and help you if you're to find yourself in the need of medical help. As a result of this, the number of people and the demand for those products, the market here is absolutely huge. We think AIA has only penetrated about 1% into its market opportunity. No doubt there's lots of other good competitors. We own a couple of them in the portfolio, but we think AIA is going to go from strength to strength. Over the last 5 years, it's grown its earnings by 15% per year, its dividends by 22% per year. It's the market leader in Hong Kong with a route into China there, the Philippines and Thailand, all fast-growing, exciting, dynamic markets. And by selling a product which everyone needs to buy, we think AIA is going to do very well under its very strong management team. So that's something we're particularly excited about at the moment. The third category is cyclical growth companies. These are companies which are subject to the macroeconomic and the capital cycle. So things may go down, but we think they're going to recover. And as I said earlier, we think the peak of the next cycle is going to be higher than the peak of the last cycle. We have a lot of banks in this category. These are cyclical companies. A lot of construction-related portfolio. Ideally, we're going to buy low and sell high, but we may also own cyclical companies that we want to hold through the cycle because we think the next peak is going to be even better. If we can find management teams who are clever enough, brave enough to take capital out of the company when things are doing well and put it back in when things are doing less badly, then that's brilliant because that will improve the returns. And we think over the cycle, these companies can grow their earnings by 2 or 3 times the average level of the stock market. So that would be in the range of 15 to 20% per annum. So very good, strong growth. And if you can buy them at the right time, you may get them at a modest valuation. And that's the case in my next example. Now I can imagine myself sipping one of Pernod's products or buying insurance. I don't think I'm going to have the need for what Orica makes because its business is industrial explosives. Boom. Mining companies need its products to help extract valuable ores from the ground and minerals. It's a very cyclical industry, as you might imagine, and this industry's been through a very serious downturn over the last 10 years. There's 2 things we really like about Orica. First of all, as you can imagine, there's a lot of regulations about setting up an explosive factory and distributing those products. So there are high barriers to entry in this market. And secondly, the cyclical M I just mentioned, mining volumes and the demand for Orica's products have fallen very sharply over the past few years. There's been oversupply, but we think the industry's starting to get a little bit better. Volumes are starting to improve, and we think there's a lot of opportunity for pricing recovery. That will mean the margins grow and the profits will grow over the next cycle, and we're pretty excited about that opportunity. And lastly, and as I said earlier, certainly not leastly, latent growth companies. These are companies that have had a poor earnings track record. They may be in an unloved industry. We want to try and identify these growth companies before the market does so we can buy them on modest valuations and see both the benefit of the appreciation of the earnings but also a higher rating that the stock market's willing to give them. We can think, therefore, we can make a lot of money out of these companies if we pick the right ones, but it is quite difficult to do. Some of the growth companies we buy here might turn out to be ugly ducklings rather than swans. And my last example here is Fiat Chrysler automobiles. Many of you will be thinking that Fiat is flailing around in the oversupplied European autos market, but in fact that's not the case. Since it bought Chrysler a few years ago, the American company has had much more exposure to the US. And the story in Fiat has been about rejuvenating old brands and generating better profits off a very large revenue base, which actually isn't growing at the moment. The revenues are pretty flat as they change their customer mix, but we think the profits can improve very much. Fiat used to own Ferrari. It spun it off. That's a very valuable company. It did it extremely well. It also owns Maserati, very exciting high-end cars. But the thing that's really driving Fiat's profits at the moment is the Jeep brand. It's increased its volumes by 5-fold over the last few years. And the sports utility vehicles that Jeep sells have much higher margins than the typical small Italian cars that we recognize so well. Car production is capital intensive, it's risky, it's expensive. This is a huge business. It's got 100 billion euros of sales. And if it can improve the margins just a little bit, then the profits can recover very nicely. And that's what's been happening. Profits over the last 3 years have improved 3-fold, even though sales have been absolutely static. Let me just summarize. Thank you very much, first of all, for listening to me today. I've talked about why you should own some exposure to global growth companies, and we think Monk's Investment Trust is a very good way to do it. I personally have a lot of my own money invested in it. We've got those 4 growth categories. That gives us a balance. It gives us growth from different perspectives. It allows us to toggle between different growth opportunities. Would Sir Auckland Geddes recognise Monk's Investment Trust today? I'm not sure he would, but he'd recognise the car industry, he'd recognise the insurance industry, he'd recognise the drinks industry, some of the things I've talked about. But we also own a lot of high technology, exciting growth companies. So whilst fashions may have changed and the top hats may have gone, we think Monk's Investment Trust is one of the most exciting opportunities from the Baillie Gifford stable. It's a strong global growth portfolio, and as we say, it's got global growth from a number of different perspectives. Thank you very much for listening to me today. I will be at the Baillie Gifford stand afterwards if you'd like to come and indulge in more conversation, and appreciate your interest today. Thank you.